students, myself CMA Padmaja Buzruk. I will discuss accounts of joint stock companies. Please go to study note number 1, accounting of shares and debentures. I will be discussing accounting of shares. Let us first just revise journal entries of issue of shares. On receipt of application money, journal entry is bank account debit to share application account, and this share application money gets transferred to share capital account by journal entry share application account debit to share capital account. Share application 1 debit 1 credit, so net effect is bank account debit to share capital account. If excess applications are received and excess application money is refunded, then journal entry is share application account debit to bank. When application money is received, you pass journal entry bank to application, and when this money is refunded back, exactly opposite entry is to be passed, share application account debit to bank. Sometimes company issues shares at premium, that is above face value. This amount over and above face value is known as securities premium, and this securities premium gets transferred to securities premium account, and share capital is to be credited only with face value of shares. Now we'll see journal entry if shares are issued at securities premium, that is shares are issued at premium and this premium money is included in allotment. Journal entry to show allotment money due, share allotment account debit to share capital to securities premium if shares are issued at premium and premium money is included in allotment. And when allotment money is received, journal entry is bank to share allotment. Now if you see share allotment 1 debit 1 credit, net effect is bank account debit to share capital to securities premium. Entry to show call money due, share call account debit to share capital, and when call money is received, journal entry is bank account debit to share call. Again, share call account 1 debit and 1 credit, net effect is bank account debit to share capital account. There can be various calls depending upon decision of the management at the discretion of the management. So it can be first call, second call, third call, etc. Entries would be same. Last call is always known as final call. If there is only one call, then that call is known as first and final call. Now let us see few illustrations. First we'll see illustration 1. PK Limited made an issue of 10 lakh equity shares of rupees 10 each, payable rupees 2 on application, rupees 4 on allotment and rupees 4 on call. All these shares are subscribed and amounts duly received. 2 plus 4 plus 4 makes 10. So shares are issued at face value, shares are issued at par, number of shares issued are 10 lakh. In order to have easy calculation, we'll consider rupees in thousands. In order to consider rupees in thousand, hide 3 zeros. So in this case, number of shares issued would be 1000 shares at 10 each. But don't forget to write on top of amount column rupees in thousand. So 1000 shares, equity shares of 10 each, payable on application, allotment and call rupees 2, 4 and 4 respectively. There is no default. Company received 1000 applications and company received whatever was due. Now we'll see how journal entries are to be passed. Just now I have told you for easy calculation, we'll consider rupees in thousand. So number of equity shares 1000, 10 lakhs multiplied by 1000. Application 2, allotment 4, call 2. That is how company will call face value. First journal entry is application money received. See here, this is how you have to prepare journal. Don't forget to write on top rupees in thousand. 1000 shares, we have converted these number into thousands. So 10 lakh divided by 1000 is 1000. 1000 into 2 they have received. Number of applications received 1000. With each application they have received rupees 2. Bank account debit to equity share application 1000 into 2 is 2000. Equity share application to equity share capital. Next journal entry, you have to show allotment due 1000 into 4. First entry is to show allotment due and next entry is to show allotment money received. Similarly, for call also you have to show first call money due 1000 into 2 and call money received. Whatever was due is received, there is no default. Equity share allotment account debit to equity share capital, allotment money due 1000 into 4. Bank to equity share allotment, allotment money received. Whatever was due has been received, there is no default. Equity share first and final call to equity share capital 1000 into 4. Whatever was due has been received. Bank to equity share first and final call. That is how entries are to be passed. Sometimes company issues shares at premium, that is above face value. Then the amount over and above face value which company receives is company's capital profit, which gets transferred to securities premium account. A company may issue shares at a premium, that is at value greater than its face value. Premium so received shall be credited to a separate account called securities premium account. We'll see illustration second, where shares are issued at premium. AB and Company Limited issued 5 crore equity shares of 10 each at a premium of 4 per share. 10 is face value, rupees 4 is securities premium. Now it is payable in various installments. These installments are application, allotment, first call and final call. Rupee 1 per share on application, rupee 6 per share on allotment, including premium. Premium is 2. So you have to write breakup of 6 here, 2 plus 4. 4 is premium. This 6 includes 4 premium. So 4 per share should go to securities premium and 2 per share should go to share capital. 3 on first and final call and balance on final call. 10 plus 4 is 14. If you add these 3, 6, 1 and 3, you will get 10. Balance on final call. So 10 plus 4 minus these 6 plus 1 plus 3. So 14 minus 10, balance is 4. 4 they are expecting on final call. Shares were all subscribed and all money due was received. except the first call money on 1 lakh shares and final call money on 1,50,000 shares. So there is default in first call as well as final call. On 1 lakh shares, they have not received first call money, and on 1,50,000 shares, they have not received final call money. For easy calculation, what we'll do, we'll consider rupees in lakhs, 5 crore equity shares of rupees 10 at 4 premium. So amount will be huge. So we'll consider rupees in lakhs. So we'll just hide 5 zeros. So in this case, number of equity shares would be 500. Now, if you see this, there is default on first call. 1 lakh shares, they have not received first call money, and you are considering rupees in lakhs. So convert this 1 lakh as 1. So on 1 share, they have not received first call, and they have not received final call on 1.5 shares. 1,50,000 divided by 1 lakh is 1.5. I will show you how it is to be done. For easy calculation, we'll consider rupees in lakhs. Number of equity shares, 5 crore divided by 1 lakh. So 500 we'll consider number of equity shares. Application 1, allotment 6. I've told you have to write breakup 2 plus 4. 2 would go to capital, 4 would go to securities premium, 3 on first call. They have not received first call on 1 lakh shares. 1 lakh divided by 1 lakh. So that means on 1 share they have not received first call. 500 minus 1, they have received it on 499 shares. Balance amount they have called on final call. This we have already discussed. Final call money is 4 per share. They have not received final call on 1,50,000 shares. We are considering rupees in lakhs. So 1,50,000 divided by 1 lakh is 1.5. On 1.5 share they have not received final call. That means they have received on 500 minus 1.5. They have received only final call on 498.5 shares. So first entry is application money received 500 into 1. First you have to show application money received and then transfer it to capital. Bank account debit to share application to share capital. 500 into 1. 500 into 1. Don't forget to write rupees in lakhs on top of amount column. Next you have to show allotment due. Allotment due is 500 into 6 and then allotment money received. Share allotment account debit 3,000, 500 into 6 to share capital 500 into 2 to securities premium account 500 into 4. We have written breakup here. 2 plus 4. 2 should go to capital, 4 should go to securities premium per share. 500 into 6, 500 into 2, 500 into 4. Whatever was due on allotment, they have received. There is no default. So bank to allotment. These are two set of entries for allotment money due and allotment money received. Next is first call. First you have to show first call money due 500 into 3 and first call money received 499 into 3. There is default on 1 share. First call money due entry is share first call account debit 1,500 to share capital 1,500. Just now we have seen this 500 into 3. 1,500. They have received only on 499 shares. So bank account debit 499 into 3, 1497. Calls in arrears account debit 3, 1 into 3. To share first call 1,500. Share first call 1,500 debit, 1,500 credit. Now next is final call due. 500 into 4 is due, but they have received only on 498.5 shares. 498.5 multiplied by 4 they have received. On 1.5 share into 4 they have not received, which is in arrears. That you have to show. Share final call to share capital. Just now we have seen 500 into 4. Bank account debit 498.5 multiplied by 4, 1994 they have received. Calls in arrears account debit 6, which they have not received, 1.5 into 4. To share final call 2000. Share final call account 2000 debit and 2000 credit. Now don't forget to write on top of debit and credit column rupees in lakhs, otherwise you will lose marks. They have asked you to prepare cash book. When cash book has been asked to prepare, it is better to pass all journal entries including cash entries. Pick cash transactions and you can easily prepare cash book by transferring those entries to cash book. First entry, bank debit 500 to share application. So cash book to share application 500. For allotment, bank debit 3000. Cash book to equity share allotment 3000. First call received is 1497. Bank to first call 1497. To first call 1497. Bank to final call 1994. To final call 1994. Take total of this, balance carried down is total of debit side by balance carried down. That is how cash book is to be prepared. Just pick cash transaction and record it in cash book. Now, just now we have seen securities premium account is capital profit. If company receives amount more, that is over and above face value, it is known as securities premium account. It is capital profit of the company. How it is to be used, how it is to be applied is given in section 52 of Companies Act 2013. That is purpose for which this capital profit, that is received on account of securities premium, share premium, is to be used. So this securities premium company can use for issuing fully paid bonus shares to its members. Company can use this securities premium account for writing of preliminary expenses or for writing of discount on issue of debentures, shares. This securities premium account can be used for providing premium on redemption of redeemable preference shares or for giving premium on redemption of debentures. Company can use this securities premium account for the purpose of buying its or purchasing its own equity shares, which is known as buyback under section 68. So various purposes for which securities premium account can be used is given in section 52. In this particular video, we have seen journal entries for issue of shares, two illustrations, and how securities premium account is used. Thank you.